Welcome to the Old Capital Real Estate Investing Podcast with Michael Becker and Paul Peebles. During this program, you will hear interviews with real-life successful investors who will share their stories and provide useful advice on how to acquire, finance, and operate apartment complexes. Now, here they are, Michael Becker and Paul Peebles.
Welcome to the Old Capital Real Estate Investing Podcast. I'm your host, Paul Peebles, National Underwriter for Old Capital. Joining me today would typically be the man himself, Mr. Michael Becker, but he is on another due diligence assignment. So in the podcast today, we have the professor, the man himself in the multifamily financing world, the professor, Mr. James Eng. James, how are you?
I'm doing good, Paul. You know, it went from summer to winter real quick here in Texas, so we are bundling up here.
It is cold. It's so cold that my pool warning filter just went off because it got down to about 34 or 35 degrees. And all of a sudden, you know, the pools, and in Texas, we have a bunch of pools, people living in their pools during the summertime. But when it gets so cold that they don't want these pools to freeze over, so you'd find 6 inches of ice in your pool. So about 2:30, 3 o'clock in the morning the other day, my pool filter went off. And so that means it's cold in Texas. So James, what's going on in your world these days?
No, I mean, we just wrapped up with the conference. You know, we're trying to finalize the date for the Old Capital Speaker Series in January. I think we're going to kick it off right from the beginning of the year. So make sure you are on our email list to get that notification. I don't know how many times people respond after the conference or after the event. They're like, I didn't even know about this event. And we've been screaming about it for 4 months or 5 months. So if you haven't, go to oldcapitallending.com. We created a button that just says subscribe, and you just put your email there. And so if you haven't done that, do that so that we send out an email every Monday and pretty much talk about deals we closed, talk about the upcoming events that we're going to be at, you know, different conferences that we're attending that maybe you should attend as well, webinars, things like that. And so make sure you are subscribed to the email list.
Fantastic. So I want to talk a little bit today about apartment appraising and valuation. So many folks in the apartment industry want to know about value. What's my building worth today? Well, you could ask 4 or 5 market participants and you'll get 4 or 5 different answers. What does the seller say? What does the seller's agent say? You know, because they're giving guidance to the potential buyer, which may have a different opinion than their client. What does the buyer think the property's worth? And if you're looking for a loan, what does the lender think? And then what does the appraisal report say? So we all look at NOI, cap rates, the amenities on the properties, the recent closed sales in the specific areas, occupancy, and is there any distress in the market? And the big thing these days is the rising interest rates and what that effect has on valuation. So today we're going to be talking about what is value today. In the podcast, we have one of our friends, Kai Pan, who leads the national multifamily housing practice for JLL for the entire nation. He's been appraising for over 17 years, and just like James, he's a graduate of the University of Texas in Austin. So go Longhorns for that. Kai, thanks for being on the podcast. We certainly do appreciate that.
Paul, happy to be on here. Thanks for inviting me.
No problem. If some alien came down from the sky, what would you say you did?
We, as appraisers, analyze market value of commercial properties. We look at the market value. We provide an opinion of market value by looking at 3 approaches to value, typically the cost approach, the sales comparison approach, and the income capitalization approach. Of course, being that my specialty is multifamily, it is an income generating asset, which means the income approach usually is the most appropriate approach to value a multifamily asset.
So you're an MAI appraiser. What is an appraiser? What is an MAI appraiser?
MAI stands for a designated member of the Appraisal Institute. Appraisal Institute is our professional organization who really keeps really the quality of our appraisal and appraisal profession up to standard. And MAI is a a significant achievement in most appraisers' careers in the market professionalism.
Yeah. So Kai is a member of the Appraisal Institute, and as an appraiser, he's an independent, objective, and an unbiased mirror on the value of properties. And so, James, I want to talk a little bit about some other different things. You had an opportunity to speak with Mike Oxtein with Price Realty at the Old Capitol Conference, and Mike, as you know, is a 40-year veteran of owning commercial real estate. He's bought and sold lots of apartments over those 4 decades. Currently owns 5,000 or 6,000 units. And one of the takeaways that I know that Mike has said in the past is, quote, "Boy, I wish I bought more real estate at these lower price points of 10 or 20 or 30 or 40 years ago." So Mike wasn't very active in the last few years because he thought the market was too high priced or overvalued, but he recently has started to buy again. And that kind of reminds me of a comment Tony Lenneman said about 10 or 12 years ago. And Tony is with JLL, and Kai works with Tony Lenneman at JLL. And so I always think about this conversation that Tony had at one of our Old Capitol bankers luncheons. And this was again about 10, 11 years ago. And we hosted a bunch of bankers from around Dallas at the Park City Club. And we usually would have 40 or 50 commercial real estate bankers come once a quarter to discuss commercial real estate lending and network. So at the time, real estate lending was shut off. And I thought it was important for bankers to hear what other bankers were doing. So are they lending? What are they lending on? What are they doing to keep busy? And I thought the funniest comment I heard at one of the meetings was that one senior commercial banker said that they usually did, and these bankers did $20 million real estate loans. But during that part of the trough of the market, he was chasing down car titles. Yes, a car title or a pink slip. So there were a lot of survivors from 10 or 11 years ago, and they went on to go do a great amount of business. But the one thing that I wanted to share that Tony Lenneman, again, that works with Kai, with JLL, said to the bankers crowd was really 2 points. Tony's comments to a bunch of bankers was to consider to extend and pretend policy for banks and agency lenders that were regulated. So have you ever heard that phrase, James?
Oh yeah. I mean, that's what we did at GE. I mean, nobody can say it was more just kicking the can down the road is what what bankers usually said in the back room. But I guess someone came out with extend and pretend, because a lot of these deals, if they were to take back the asset today, the lender would have to take a write down on the deal. And so, all these companies are public. GE was public at the time. And so if you had a loan of, let's say, $36 million, took back the asset, all right, what's it worth? $30 million. Then you wrote off $6 million right then. But if you kick the can down the road and 2 to 3 years or 4 years or 5 years, and that person kept paying you, then it was still worth $36 million. The loan was still worth $36 million, and that gave time for the value to come back.
Yeah. So the extend and pretend, it really is just what James was saying. It refers to the practice where loans were extended and losses were deferred, all to maintain the facade of stability and prosperity. The extend and pretend strategy gained prominence in the aftermath of the 2008 financial crisis and the subsequent economic downturn. And faced with the harsh realities of struggling real estate market, investors and lenders clung to the hope that they would buy time and pretend that everything was fine. So by postponing the recognized losses and the engagement in possible accounting tricks, they sought to weather the storm without inflicting significant damage to their balance sheets. What Tony was trying to convey to a bunch of bankers was to, quote, give your borrowers additional time. Don't foreclose upon the asset at maturity. A foreclosure will not help the lender or the borrower. If the borrower needs additional time, give them a path to work out a solution between the bank and the borrower. And I thought that was great advice and probably very applicable today with a lot of these, say, bridge loans. What's your take, James?
Yeah, I mean, nobody wants to see a foreclosure happen. It really is, the last remedy. We're seeing a lot of deals that maybe bridge loans were done in, let's say, 2021, 2022. If it was, the maturity was in 23 or 24, it's coming like a train coming down the tracks. And a lot of people are having to figure out, what do I do right now? And so that's a question sort of on the financing side that we can talk about. But, I think from the appraiser standpoint, I was at a conference last Friday, and, one of the guys who was around in the great financial crisis, he was saying that appraisals have been, I'm not going to say they were easy in 21 and 22, but the trades were all, it was like, it was 80 a door. So when I started, an 80s deal in Dallas was 80 a door. Then it went to 90 a door, then 100 a door. And it just ratcheted up, ratcheted up, ratcheted up. And then, but now we're starting to see, I mean, Kai, you're in Houston. And so we've seen some foreclosures on deals, and it sort of resets the basis a little bit. And so we've seen deals that have been foreclosed, and, they've been bought for 50, 60 a door. Those are probably C deals. But how does that impact you? I know you went through income, sale, and cost approach. But one of the guys last Friday was saying that, like, these appraisals are going to get a lot harder before they get easier. So any take on that, sort of building those into your model on the sell comp approach?
Yeah. So, like you said, 21, 22 were relatively easier times to appraise. Appraisals are easy when there's a lot of sales, high transaction volume. Market transactions between willing buyer and willing seller make the market. We observe and hold a mirror up to the market. Makes our job relatively easy. Nowadays, transaction volume has slowed way down. Some of the transactions that have occurred were due to distress of some kind, like you said, in Houston, where the assets themselves were unstabilized, which means that there's additional layer of risk in the purchase price, that's being priced in. In today's market, we're listening to buyers and sellers and brokers. Not saying that we weren't listening to them before, but listening to them regarding the story of the transaction or story of the marketing process. What within the deal makes a deal attractive, what within the deal makes the deal unattractive to buyers. We hear stories from brokers on two seemingly similar deals, one that attracts lots of tours and lots of offers, and another one that didn't, and what went into each of the deals.
Can we take that? Can we pull on that a little bit? So give me an example of a deal, let's say in the last 3-4 months, that where there was a lot of tours, a lot of offers, and then the vice versa.
Yeah. The lot of tours, lot of offer case usually comes from where the deal has a clear visible upside in year one, whether there is a strong case for just below market rent, or something that can be fixed fairly quickly in the rent roll to achieve economic stabilization. In today's environment, in where a lot of deals that transact are in the negative leverage territory, the thing that pulls you out of negative leverage is outsized NOI growth. So deals where you can see significant path to NOI growth in year one, year two, they get a lot more play. Vice versa, the deals that don't get a lot of traction are sometimes counterintuitive. They look nice. They have been delivered and going through lease up. However, the lease up trade outs may have slowed down in terms of rent growth. There isn't a visible rent growth in year one happening. A lot of buyers are not underwriting rent growth in year one, but when you kind of see it in the lease up process, that typically kind of turns a good amount of buyers away, and then the buyers that end up staying are offering higher cap rates. So really, I think the market is funny in a way where deals that are happening are in some cases, some may argue outliers, where the cap rates being paid are still quite good for the seller. And there's a lot more bids that don't make it than the one that end up winning. And our job as appraisers is to reflect the market on the closed transactions. Even though we still have to really tell the story, we recognize that interest rates have gone up, even more so in the last 90 days. However, we need to look at the full picture of closed transactions to really tell the story of valuation.
Do you know, I don't know if you have these numbers offhand, but I'm just gonna fire away and hopefully you can give us a general idea. Sort of, all right, like 21 to 22, sort of number of transactions. You can either do Texas or you can do Houston. Number of transactions that closed roughly. Any ideas on the multi side for Houston?
I don't
Okay.
I don't have that number.
Okay, but percentage wise, this year, what do you think number of appraisals you'll do in 23 versus 22? Any rough?
I think the overall transaction market is down anywhere between I think 60 and 80%
Okay.
in different markets. And our volume of appraisals based on transactions have gone down about 30% or so. Yeah, we definitely see the reflection of today's market where there's way less transactions.
So you're the national head of multifamily housing across the United States. And so you see different areas of the country. What is the better of the bad in terms of volume of business? I mean, is Florida, I mean, we've talked about the United States being down maybe 80% or Texas being down 80% of volume transactions. But what's the shining stars? Is it New York? Is it Florida? Is it Texas? Is it California? What has less of a decline than the rest of the United States in like a percentage basis? What areas?
I would say Dallas and Texas have been really well held up in terms of valuation, and transactions for at least the first half of this year. So if I were to hold up a shiny star, I would say Texas. And even then, we're talking about this much downward trend in transaction volume. There's certainly other markets across the country where there's probably quicker drop in valuations and quicker recognition from the seller that the pricing have moved, and that transactions have been more fruitful, or at least discussions around the bid-ask spread have been more fruitful in some of the core markets. The gateway markets such as Chicago, where cap rates have gone up and transactions have reflected upward movement in cap rates. So the markets where the volume have stayed down probably are due to wide gap between buyer and seller's expectations.
Yeah, I mean, we had a couple deals. So these are deals that you're not even seeing yet because I mean, there's probably been 3 deals in the last month that pretty much the seller had a number in their head. The broker gave them a number over the summer. They put it out to the market, and the broker's like preparing the seller like every day, like, hey, we told you it was going to be 40 million or 42 million, but every buyer that we tour, they're coming in at like 35 or 36 million.
Mm-hmm.
And so, we just had a call for offers on a deal last week, and the brokers called the buyers back and just basically said, well, we're 5 million off. The seller wanted 40, best offer was 35. So a lot of deals aren't even making.
Yeah.
And so you're not even seeing them go. But the deals that you do see that, people are engaged, they're doing a loan or they're doing a refi. Let's just stick on the acquisition side. Cap rates compressed significantly, 21, 22. Where do you see sort of ABC caps right now? You can take it either Houston or you can take it even Texas.
Yeah, I think A caps are, I think if you asked me this question maybe 60 days ago, I would probably say you'll still find deals in between 4, 5, and 5. Today, probably that's moved up to right at 5. If you want to see transactions, 5 and 5.25 would be my A cap rates, and then 5.25 to 5.75 would be B, and then we're clearly seeing some transactions in C class, in the 6s, but I will say 5.75 to 6+ in the C.
Okay, I would say
6 plus.
I would say those are seller cap rates. So I think if, let's say, a deal is at 5.25 to 5.5, that I think a seller would go at that number. But I think most buyers are wanting like maximum 50 basis points negative leverage on their deal. And
Mhm.
so if we give them a Fannie quote at 675, they're just like, we can't pay more than 625 on a cap right now. And
Yeah.
so that gap is where people are just staring at each other right now, between buyers and sellers, because they just, the a lot of these sellers, they have maturities, but they're coming up 6 to 12 months now, and so they have a little bit of time, and some of them can buy the interest rate cap, and so they're just going to kick the can for another year and hope the 10-year comes down. But I think what on the acquisition side, I think we're seeing similar things. Um, are you seeing anything on the refinance side on your appraisals, or any of the lenders? We're thinking about this guy stopped paying, or this guy wants to work out, and we want to know the value. Are you seeing any of that from lenders?
We're seeing a little bit of pickup in that type of appraisal orders. It's still not at the volume of what it was in GFC or post GFC, but we are seeing a steady trickle in of special servicing appraisal requests, or lender kind of telling a story of like, this is what happened to this deal. I like to know what my collateral value is, kind of like an internal thing as opposed to an action on the borrower. And it's interesting to kind of go into a deal. Some of them are very clearly, they were acquired in the height of the market. And, sometimes you get a previous appraisal, and you see what the business plan was, at the time of acquisition, what the underwritten rent growth was, obviously the cap rate paid at the time. We all know kind of what we would be, even at the most aggressive case, the cap rate today is still a whole heck of a lot higher than then. Then you kind of look at what's happened to the NOI. Some of the deals, they've executed a good bit of their business plan and they have achieved a rent growth on the units that they've renovated. However, the taxes and insurance have really ate up all of the NOI growth. Some of them have struggled operationally. Operations, I think, is definitely underrated. Maybe from a couple years ago, but there's deals where you look at that have issues with their roles, issues with lowering standards to get the tenants in, bad debt, and just kind of maybe not due to maybe regulations or just management, haven't been able to clear the rent roll to have paying tenants, and those are the things that kind of plague you know the the deal themselves, and get themselves into where they fall into our hands right at special servicing.
Yeah, I mean, Camden is a huge owner based in Houston, down where you are. And on their quarterly call, I mean, pre-COVID, their delinquency, their bad debt was like 50 basis points
Mm-hmm.
for like 30 years. So they own sort of A minus stuff, A plus, they do some new development. So 50 basis points was their run rate. And then they said in the last quarter, it was close to 300 basis points. And so a lot of that was California, some of it was Atlanta, but it's been hard on the bad debt and people just leaving, or hard to get people out of some of these units that aren't paying. So the bad debt is just going on and on. But you touched on insurance and taxes. How, like, when you guys are doing an appraisal now, we usually had good rules of thumb for what to use for payroll and R&M and insurance. Like, we would just sort of plug those numbers in. Can you go down just sort of the expense column and give us sort of your dollar per unit? It can either be Houston or Houston's probably an anomaly for insurance, but for the rest of the categories, what are you seeing? Because we look at a lot of T12s, but you look at more T12s than me. So
Can you
what are you
bring
seeing on that?
that insurance cost per unit to 350? I know that you want to keep pushing it up, but can you bring it back to what it was 5 years ago?
All I gotta say is I'm hearing some creative solutions out there. It's just everybody's kind of putting their head against the wall and trying to figure out, how we can kind of get past this insurance thing. Payroll has gone up a little bit, but I think I'm seeing, your typical, garden style payroll is like 12 to 1600. R&M, one thing about R&M that we've seen kind of materialize over the past year is turnover expenses have been higher. Some of them from value add operators who probably have a bit more in the R&M during the value add phase, but we are seeing R&M and turnover be up slightly. Probably, we're talking about 500 for other repairs, maintenance contracts are turnover at about 300 to 400. Utilities, I think that's been it hasn't been a huge increase based on what I could tell. So it's just your typical inflation there. And then G&A and marketing really have been kind of a typical nominal increase. So that's probably on the low end. You probably see 300-400. On the upper end, it probably goes to 1,000 especially if cable gets put in there.
So the controllable stuff has been fine. It's the uncontrollable, quote unquote, insurance and taxes. So insurance, in Dallas, it might be 1,000 a door. In Houston, are you seeing like 2,000 to 3,000, or what are you seeing in Houston right now?
I've seen 2 handles. I don't think I've seen 3 handle come across yet, but 4 digits is a typical underwriting. You get one that comes across every once in a while. That's that may surprise you, but generally it's going to be 4 digits.
And James, why is it so high in Texas or in Houston, Florida?
It's a supply and demand problem to some extent, but at this conference last week, they showed a chart and it pretty much was like they showed the amount of money that these insurance companies have paid out for these hurricanes and windstorms and hailstorms and all these things and flooding. And in the past, I think it was like a couple billion a year. And then just the last 2 or 3 years, it's been like 30 to 40 billion per year. And just that change, the guy on the other side of the trade is like, I'm out. And so as more and more insurers pull out of these markets, there's only one guy who's willing to take on that risk, and they're going to get paid for that risk. And so, they're going to write the insurance, but they're going to charge a lot for it to make up for. They might be trying to make up for the last couple of years where they lost money. So it is not an easy business. And so when there's limited supply, you have to figure out a way to get it as low as possible, or just underwrite it as part of the deal.
In property taxes, Kai, what are you seeing right now? Texas is going through a little bit of a revolution on property taxes to extent. What's your take right now?
Yes, we track a property tax reassessments based on purchase price kind of over the years in Texas and all across the country. So we'll be really interested to kind of get the final certified numbers and for 2023 and kind of compare that to previous year trends and also the preliminary numbers. The 2023 has been a challenging year with respect to valuation. I think partially because the data that the appraisal districts have used to value properties in January 1 a lot of it were from the booming times of 2022, and the market have shifted very, very quickly in the last quarter or second half of 22. But there's certainly an adjustment that needs to be made. We're working on quite a few tax appeal appraisal work as well, in terms of kind of looking at what the actual market value is compared to their assessed value. And generally what we've found is the delta between the preliminary, the notice values to the certified values that we've tracked this year is probably between 10 and 20% downward, with an average of 15 or 16. So at this particular juncture, we can kind of say that assessments appeals will, at a minimum, come down to the purchase price, by the end of the year in most cases. Obviously, Texas is a non-disclosure state, so they wait for the appeals process to go through to kind of look at, your purchase price and all that to really kind of make that determination.
And James, if somebody is trying to get a loan and everyone thinks the property taxes are decided maybe by the seller or the county, or that maybe we've heard maybe 80% of the purchase price or 90% of the purchase price, 70% of the purchase price. Really, who makes the decision of where property taxes are in the transaction for the lender? Is it the buyer? Is it the seller? Is it the tax consultant? Who's the person who makes the decision, James?
Well, it's easy to say. So the appraiser is going to give their opinion, but it's ultimately the decision of the lender and their underwriter, right? So if Kai comes in at 80% of the purchase price, he's got the data, he's got 5 comps, that's his guess for 2024. Fannie Mae might take that appraisal and be like, yep, sounds good to me. Whereas Freddie Mac might say, well, Kai, I appreciate the 80%, but we're going to 95 because in that submarket or in that county, all my stuff went to 95. So sometimes there's a recency bias and then a bridge lender who is being more conservative right now might say, Kai, I appreciate the 80%, but I'm taking it to 100. So it is ultimately the discretion of the lender's underwriter to decide on where they're going to be. But typically, they're not going to be under Kai's 80%. Like most bridge lenders aren't going to say, thanks for the 80%, but we're going with 60, right? If they go with 60, they're probably not going to be in this business for that long. And so I think everyone's taking sort of an opinion of where they think it's going to shake out. And, the listing broker might have even a lower number, right? But everyone's going to take an opinion of where it shakes out. And ultimately, it comes down to the county and the tax protest guide that you used and what it comes in at.
So last 10 years, we've seen a huge amount of value added properties, and the appraiser has to take what comes from the buyer in terms of pro forma and the rehab dollars and where that money is going to go to, because they're trying to create value on the acquisition. Kai, are you seeing very many true value-added properties these days that they're giving you a pro forma and they want you to come up with the value down the road these days? Is it greater than it was 5 years ago? Is it zero? Or most of these properties are already stabilized? I mean, where are the buyers coming at these days? What are they buying?
Yeah, there's still value add appraisals, value add opportunities that we're seeing. It's obviously a lot less than 21, 22 because the cost of debt for bridge debt, which is usually for value add acquisitions, is much higher now. So, but we are certainly seeing them happen, very sparingly, and the lenders themselves are very keen on the appraisal report being well supported in terms of the market rent. The rent growth assumptions get a second look at certainly some of the capital markets assumptions as well. So, but those opportunities are out there. Obviously, some apartments are not stabilized maybe today, or that they are clear cuts in terms of the opportunity to renovate and increase rent.
God, I think right now appraisals haven't been a challenge in the past. Most deals have been sort of debt service constrained on the Fannie and Freddie side. At some point, when I started in 15 and 16, a lot of these deals were 80% levered. And, it was covered at 130 or 135. And so with some of these values being reset, especially on the B and C stuff, I don't think the A stuff is ever going to get back to 80%, or maybe we should buy it all. But if the B and C stuff goes to, positive leverage, you're buying on a 7 or 8 cap, and then you're working off of these sort of lower numbers from foreclosures that we talked about, how does that impact your appraisal? And then how do, I'm not going to say anybody influences the appraisal, but you guys sort of take in data from the listing broker, the borrower. What's the right way to work with the appraisal group that's engaged by the lender? What's best practices? Maybe talk about best practices. And I always like to say, criticize what? No, we'll just stay to the positive stuff.
Yeah, absolutely. We are data hounds, so please provide us with comps, with data to support really the transaction or really your opinion of value. Again, our job is to provide a opinion of value, just like it is the job of every other real estate professional. So, we certainly will want to review data, review the assumptions that go into some of the data in the valuations. We get sent BOVs, in certain times and really review some of the assumptions, and we love doing that. Another thing that will help is tell us the story of the property. A little bit of a context will make us understand the property better. We come into this project, from day one, and 2 or 3 weeks later, the report is out. We touch it for a very short amount of time compared to the brokers and of course the property owners. So we have to kind of cram in a whole bunch of information. So the earlier the information gets transmitted about the context of the deal, the better. For the appraiser, you know, I love to hear the story of when it was acquired, what was the cap rate, what was the purchase price, how much was spent on it, and how much rent was boosted from the business plan. Really give the complete picture. Makes our job easier to tell that story. Anything in the historicals that are not stabilized, this is something that everybody kind of default to the T12 right away. But if you really identify a few items that are not markets, especially maybe in the BC space where you have less sophisticated management, you want to tell the story, hey, this particular expense item really should be normalized and set to market. And that's something that appraisers have a lot of data on expenses, income expenses, and really that's something that they should be able to consider. So data, story, and earlier in the process.
What's okay? We never like to name names, but what is some bad practices or things that you don't recommend? I'm sure, like we always tell people to not do certain things, but anything that has happened, I'm sure you've walked a lot of properties or worked with done a lot of appraisals. So anything that you recommend people not doing, because sometimes that's easier to remember.
Well, I think just like the property looks the way it is. Impression matter. When the appraiser, the PCA guy, ESA guy, and the lender is all on site. If the property looks like a mess, that makes a strong impression on everybody involved. I think just kind of having a quick response to data request when a borrower is disorganized and takes a long time to get the data back to us. We usually delay our process, and then the entire loan process, gets delayed. So that's one of the bigger pet peeves is, get us data early. Most appraisers will be on time if you get the data in early, and really, just answer any questions. Just we really don't like borrowers who kind of turn their backs against us and just let us run our process. Usually, that creates conflict or a mismatch of what they believe the property is versus how we see it, and there's no way to verify information. It makes our job harder. There's a higher chance that the report could be late or delayed. So just be responsive to your appraiser.
Yeah, yelling and screaming at the appraiser doesn't work. Trust me on that one.
Yeah. After the fact is a lot harder, than obviously, before the fact.
So going back to what I was talking about at the beginning, during that conversation that Tony Letterman, who ran JLL and the appraisal group, and I don't know, is he your boss, Kai?
He's my boss. Oh
yeah. Again, super guy. But the other part of the conversation that I thought that I took away from that banker's lunch a long time ago, and I thought that was the most important, was that we have these pullbacks in real estate, and they're pretty much just temporary. They're not long-term pullbacks. Temporary meaning that could last a few months or just a short amount of years. And I'm talking about anywhere from like 18 to maybe 20, 28 to 36 months. But historically, the value of American real estate is like a freight train, and it continues to be strong and it keeps going. He showed a graph that captured 100 years of real estate prosperity in the United States. And when I saw that graph, I became a big believer in the resilience of commercial real estate. So when you're contemplating making an investment in commercial real estate or adding to a current position like a capital call, I believe in the strength of American real estate for the long term. So I like Tony's comments, and we'll always remember those. And when we have these temporary pullbacks, Kai, any final thoughts or words of wisdom? Since you've been in the business for a long period of time, just less than 20 years or so, I mean, what is your take on commercial real estate these days?
I think this year, it's going to be tough. There's a lot of uncertainty in the market. Really, just getting a well-supported value opinion, from your trusted professionals is really key in decision making. We're all trying to figure out what's going on here. Really, we're all doing our part to help the industry to navigate this this environment and really get to a better place, hopefully sooner rather than later.
James, any final questions or comments?
No, I appreciate you coming on. I mean, it definitely is tricky valuations right now. Everyone has a different opinion of it, but I mean, you guys see a lot of stuff. So I appreciate you coming on and sharing your wisdom.
Thanks, Kai.
James.
And we appreciate that quite a bit. Again, Kai is the Executive National Director of Multifamily throughout the nation. He's based out of Houston, Texas. Don't call him directly, please. But I certainly appreciate Kai jumping on the phone and talking with us a little bit about what's going on in the market these days, and especially appreciative to Tony Lenneman and all the great sage advice about what's going on in the real estate. Even 10 years ago is certainly true today. So again, Kai Pan, we certainly appreciate it. James, the Professor Eng, thanks very much. I'm Paul Peebles. Have a great day.
Thanks for listening to the Old Capital Real Estate Investing Podcast. Please join us at oldcapitalpodcast.com to sign up for our weekly email updates. We'll see you next week for another great interview.